The wire cleared this morning. You own a bank. You probably picture what everyone pictures: a marble lobby, a row of tellers, a wall of brass safe deposit boxes, and somewhere in the back, behind a door thicker than your arm, a vault. All of that is real. It's also the cheapest, least important thing you just bought, the costume, not the business. Because before you could hang your name over that door, a federal agency had to decide you were allowed to exist at all. And these days, almost everyone who asks is told no. By the end of this, you'll know what a bank actually sells, and it isn't loans. You'll know why the safest thing on its balance sheet is the thing that kills it, why a bank can vanish in less time than a long weekend, and why the best deal in banking is buying one that's already dead. So start where you can't, building one from scratch. In the trade, it's called a de novo bank, a brand new charter, a bank that didn't exist yesterday. To open one, you don't ask a landlord, you ask the government. A charter from a state or the Office of the Comptroller of the Currency, deposit insurance from the FDIC, two separate approvals from two separate agencies on a business plan that has to survive years of review before you take in a single dollar. And the money to start isn't the building, it's the capital regulators make you hold against the sheer risk of existing. For a new bank, the FDIC wants enough to keep a Tier 1 leverage ratio of at least 8% through your first 3 years. In practice, that's $20 to $50 million in cash before you've written a single loan. For you, that's not the obstacle, and we both know it. 20 million is a number you've wired for less interesting reasons. The obstacle is that even with the cash in hand, the door is mostly shut. Here's how shut. Between 2000 and 2008, America approved new banks at a rate of about 130 a year. Then the financial crisis hit and the regulators quietly stopped saying yes. Since 2010, the entire country has produced fewer than 6 new banks a year. In 2024, 6 opened, 6. In a nation of about 340 million people, so the whole industry has been shrinking for 40 years, from a peak of around 14,400 banks in the mid-1980s down to roughly 4,000 today. Nobody's building, everybody's merging. Which settles it: if you want a bank this decade, you don't start one, you buy one that already exists. And there's a steady market for exactly that. Community banks, the ones holding $50 million to $1 billion in assets, change hands constantly because their owners are aging out and the small ones can no longer carry the compliance bill. Take a real one. In July of 2025, a Michigan bank called Mercantile agreed to buy Eastern Michigan Financial, a bank with $505 million in assets, for $95.8 million. Call it a rounding error on your net worth. Now look closely at what got bought, not the branches. Eastern Michigan had $208 million in loans, ordinary, unremarkable loans. The prize was on the other side of the ledger. It had $449 million in deposits, and it paid for that money an average of 42 basis points a year. 42 basis points. Keep that number. We'll come back to it, and it's the whole video. And here's the part that should stop you. In deals like this, the buyer routinely pays a premium, real cash, over and above book value, specifically for the deposits, for the money the bank owes back. Sit with how strange that is. You are paying extra to take on other people's IOUs. As for the sticker price, community banks trade in a tight band, usually somewhere between 1.25 and 1.5 times tangible book, the hard assets minus what's owed. In 2025, the average deal went for about 1.46 times book, but the price is the easy part. The hard part is that you don't simply buy a bank. First, a regulator has to approve you. Under the Change in Bank Control Act, before you can take a controlling stake, you file a notice and wait 60 days while the Federal Reserve investigates you personally, your finances, your background, the source of every dollar you're putting in, and you sign up for something called the Source of Strength Doctrine. In plain terms, if your bank ever gets into trouble, you are expected to prop it up with your own money. They want a rich owner who'll bleed for it, which frankly is part of why you're a good candidate. So the barrier was never the money. It's that a federal regulator has to look at you and decide that you, personally, are fit to own a bank. Assume they decide you are. The keys are yours, so what's the first thing you're afraid of? If you're like most people, it's the vault, the mask. The note slid across the counter. Forget it. In all of 2023, there were 1,362 bank robberies in the entire United States, the fewest since before 1990, and the typical haul was under $5,000 against a $500 million balance sheet. That isn't a risk. It's a rounding error with a getaway car, and every dollar of it is insured anyway by a thing called a banker's blanket bond, the standard policy covering robbery, fraud, and dishonest employees. The man in the mask is the one threat to a bank that's completely solved. The thing that actually kills banks never goes near the vault. It lives quietly on the balance sheet, and it's invisible right up until the day it isn't. Here's the trap you're now sitting in. Your depositors can ask for their money back tomorrow morning, but you've lent that money out for years, a 30-year mortgage, a 10-year treasury bond. You are borrowing short and lending long. Everyone in banking does it. It works beautifully until interest rates move. When rates rise, the bonds you already own, locked at yesterday's lower rate, quietly lose market value, and the depositors funding them start eyeing the bank down the street that's suddenly paying more. That mismatch has a name: duration risk. Your assets are long, your funding is short, and the gap between them is where banks silently die. Hold that thought. A real one died of exactly this, and later we're going to watch it happen. But duration risk is only half the picture, because it raises the real question, the one this whole business turns on. If borrowing short and lending long is this dangerous, how does a bank make money at all? The answer is the most misunderstood thing in finance. You assume a bank makes its money by lending. It doesn't really. It makes its money by funding. Start with the number every banker quotes: net interest margin. In plain terms, it's the gap between what a bank earns on its loans and what it pays for its money. For America's community banks at the end of 2024, that margin was 3.44%, 3.5 cents on the dollar, a year. That sounds thin, it is thin, and it's the wrong side to stare at, because that margin is decided almost entirely by the cheap side, the funding. Watch what happens with two banks. Identical loans, identical borrowers, identical interest coming in the door. One funds itself with checking accounts paying almost nothing, the other has to bid for its deposits at 4%. Same assets, wildly different bank. The winner isn't the better lender, it's the cheaper borrower. So back to your 42 basis points. Eastern Michigan didn't get bought because it made clever loans. It got bought because it had spent decades collecting depositors who leave their money there at almost no cost and don't move it when rates rise. That stickiness has a name too: deposit beta. It measures how much of a rate hike you're forced to hand back to your depositors. Say the Fed raises rates by a full point, and you raise what you pay savers by only 0.4 of a point. Your deposit beta is 40%, and you keep the other 60 as pure margin. The lower your beta, the more of every rate hike you simply pocket. And the best deposits of all have a beta of 0 because they pay 0. A checking account earning no interest is, to you, free money. You pay nothing to hold it, and you lend it out at 7%. This is the inversion the whole video's been circling. On the accountant's page, deposits are a liability, money you owe. In reality, they are the single most valuable asset a bank owns. You are, quite literally, being paid to hold a debt. It's so real that accountants put a dollar figure on it. When you buy a bank, part of the price gets booked as the core deposit intangible, a hard number representing what that loyal, cheap deposit base is worth. That's the premium you couldn't explain a few minutes ago. Now you can. Follow a single dollar to see the machine turning. A depositor hands you $1. You owe it back, but until they ask, you lend it to a home buyer at 7%. You pay the depositor 42 basis points. You keep the rest. Now do that 600 million times. And now the part that makes it one of the great legal money machines ever built. Leverage. A healthy community bank earns about 1% a year on its assets, its return on assets. In 2024, community banks averaged a bit over 1%. 1% sounds pathetic. It isn't because of how the bank is built underneath it. A bank funds roughly 90% of itself with other people's money, the deposits. Only about 10% is yours. So that 1% earned on all the assets lands on your thin slice alone. 1% on the assets, levered 10 to 1, is about 10% on your equity every single year. On your $500 million bank, that's roughly $5 million a year on about 50 million of your own money. A boring, reliable 10% forever. As long as one thing holds, the deposits stay, and they stay cheap. Everything from here is about that one condition, because the same leverage that turns 1% into 10 turns a quiet week into a bankruptcy just as fast. Which raises a fair question. If deposits are this valuable, why doesn't every fintech, every tech giant, just take them? Why is this still a club? Because a bank isn't the branch, and it isn't the app. A bank is a set of pipes almost nobody is allowed to plug into, and owning one means owning a seat on those pipes. It starts with the master account. That's your bank's own account at the Federal Reserve, the account where the money finally actually moves. When your bank sends money, what physically happens is a number moving between master accounts at the central bank. Without one, you aren't really a bank. With one, you're wired straight into the machine that settles the whole economy, and a handful of rails run through it, each for a different job. The heavy one is FedWire. It's real time, it's final, it's irrevocable. Once a FedWire payment lands, it cannot be pulled back. It settles the same day, and a single transfer can move up to $10 billion, and it costs your bank about 97 cents. $10 billion moved with total finality for under $1. At the volumes the biggest banks run, that fee drops below 4 cents for everyday money, payroll, the utility bill. The rent banks don't touch FedWire. They use the ACH network, which batches millions of payments together and clears them overnight for a fraction of a cent apiece, slow, cheap, and quietly moving the bulk of American money. And since July of 2023, there's a third rail, FedNow. Instant payments around the clock, settling in seconds for about 4.5 cents a transfer. The plumbing finally caught up to the internet. Now watch what happens the moment your bank sends a wire. A customer asks to move $1 million. You debit their account, you instruct the Fed, and the Fed moves $1 million from your master account to the receiving bank's master account, done, final, and irreversible in minutes. But all of that only works if you hold a master account, and thousands of small banks don't touch the rails directly at all. They rent access instead through a bigger bank called a correspondent, which runs the wires and the settlement on their behalf for a fee. So the whole system is a hierarchy of access. And the gate at the very top, the master account itself, is not a right, it's a decision. Ask a bank called TNB, the narrow bank, no gimmick, no exotic business, was a plain, ultra-safe bank that wanted to do exactly one thing, take deposits and park them at the Fed. It applied for a master account and it waited more than 6 years. Then the Fed said no. A fully legal, fully chartered bank denied the one account that makes a bank because access is discretionary, and the Fed simply decided it didn't like the model. That's your real moat, not the vault, the permission. Your deposit franchise is defensible precisely because the pipes behind it are a gated club and you were let in. And those same pipes are where the model shows its darkest ceiling. Remember correspondent banking, a big bank quietly moving money for smaller ones it barely sees. In the 2000s, Wachovia ran correspondent accounts for Mexican currency exchange houses and let more than $378 billion flow through them with almost no scrutiny, money the cartels used, in part, to buy aircraft. In 2010, Wachovia admitted it had policed none of it and paid $160 million to make the case go away. $160 million against $378 billion moved. That's the ugly edge of owning the pipes. The same access that makes your deposits valuable makes your bank the perfect laundromat, and the fine, when it lands, is a rounding error against the flow. Which is exactly why they vet you so hard before handing over the keys. But money laundering is the model abused on purpose. There's another way this ends. No crime, no villain, just one ordinary bad bet on interest rates made by the bank everyone thought was the smartest in the room. By early 2023, Silicon Valley Bank was the 16th largest bank in America, with $209 billion in assets. It was the bank of the entire tech industry, and it had a problem hidden in plain sight. It had taken in a flood of deposits, $175.5 billion of them. But here's the first crack. 86% of that money was uninsured, above the FDIC's $250,000 limit, held by companies that watch their balances like hawks. Hot money, the exact opposite of your sticky little Michigan deposit base, money that would sprint for the door the instant it got nervous. And what had SVB done with all of it? Precisely what you were warned about back in Act 4. It bought bonds, about $117 billion of them, more than $90 billion locked away as hold-to-maturity, long, safe, government-backed bonds. Then the Fed raised rates at the fastest pace in a generation, and every one of those safe bonds frozen at the old low rate, lost market value. On paper, SVB was sitting on billions in losses it hadn't yet had to admit, safe funding, except it was uninsured and skittish. Safe assets, except they were underwater, two perfectly safe-looking things that bolted together were fatal. Now watch how fast it goes. On March 8, 2023, SVB admitted it had sold $21 billion of bonds at a $1.8 billion loss and needed to raise $2.25 billion in fresh capital to plug the hole. It was meant to reassure everyone. It did the opposite. The only thing the market heard was, the bank is short of money. The next day, March 9th, depositors tried to yank $42 billion out in a single day, a quarter of the entire bank gone by nightfall. This is the run you're supposed to hold capital against, arriving all at once at the speed of a group chat. On the morning of March 10th, regulators walked in and closed it. From the reassuring announcement to the seized bank was about 40 hours, the second largest bank failure in American history, dead before the weekend. And now the detail that makes it sting. On February 27th, 11 days before the collapse, SVB's chief executive, Greg Becker, sold $3.6 million of his own stock under a trading plan he'd filed on January 26th, legal scheduled. Disclosed, filed well in advance. And if you're keeping score, filed about 6 weeks before the bank he ran ceased to exist. Funny coincidence, SVB's owners were wiped out, their equity to zero, the end of the story for them. But not for the bank itself. Because here's the mirror. 2 weeks later, on March 27th, another bank, First Citizens, bought the wreckage from the FDIC, and the terms are the entire point. First Citizens took on about $56 billion of SVB's deposits and bought $72 billion of its loans at a $16.5 billion discount. It was paid, in effect, to walk in and take the franchise. The market understood it instantly. First Citizens stock jumped about 50% in a single day. The FDIC, meanwhile, swallowed the loss, around $20 billion out of the insurance fund. One owner's deposits ran out the door and erased him. Another owner bought those same deposits at a discount and got 50% richer by lunch. Same franchise. Opposite endings. The only difference was which side of the run you were standing on when it started. So if you're going to own one of these machines, SVB hands you 5 rules. This is the only list you'll get from me. First, keep your funding sticky and your deposit beta low. The entire value is depositors who don't leave when rates rise. Court them like the asset they are. Second, never fund long bonds with hot money. If your deposits can leave tomorrow, your assets cannot be locked up for 10 years. SVB broke this one rule, and this one rule broke SVB. Third, watch your uninsured concentration like a fuel gauge. 86% uninsured was never a sign of success. It was the fuse. Fourth, mark your safe bonds to what they'd actually sell for today, not to what they'll be worth if you can hold them to the very end. Because on the day of the run, hold to maturity is a fantasy. Fifth, hold capital for the run you're certain will never come. The one that never comes is precisely the one that ends you. Time to pull it together and answer the question you actually bought this for. How much do you make? Base case first, you do the same boring thing. You buy the clean Michigan-style bank. Around $500 million in assets, a sticky deposit base, for somewhere near 1 1/3 times tangible book. Call it a bit over $100 million all in. It throws off that reliable 1% on assets, roughly $5 million a year on about $50 million of your own equity. 10% compounding, boring and real, but don't expect it overnight. A deposit franchise is grown, not bought. It took Eastern Michigan decades to train its depositors down to 42 basis points. You're buying time as much as a bank, and the value only compounds for as long as you keep those depositors loyal. It will never make you a headline. It will make you about 10% a year through booms, busts, and the occasional recession, which is exactly why the people who own banks tend to keep on owning banks. Now the other scenario, the one that doesn't come from a broker, it comes from a disaster. When a bank fails, the FDIC has no interest in running it. It wants the thing gone by Monday, so it sells the corpse, and to move it fast, it sells it cheap, often with a loss share deal where the government eats most of the downside. That's how First Citizens got $72 billion in loans at a $16 billion discount. It's how, back in 2009, an investor group bought the remains of IndyMac, $20.7 billion in assets at a $4.7 billion discount, with the government backstopping the losses. In deals like that, your effective purchase price on the deposit franchise isn't a premium at all. It's negative. You are paid to walk in and take the one thing still worth having, the depositors. That's the real ladder in this business. At the bottom, you buy a good bank and earn a quiet 10% for 30 years. At the top, you're the one with the capital and the license, standing ready the day someone else's bank dies and you take their deposits for less than nothing. Both are the same trade, deposits cheap, sticky, funded 10 to 1. One kind you pay a premium for, the other kind the world pays you to take. So that's what you really bought this morning. Not a vault, not a lobby, not a wall of brass safe deposit boxes. You bought a license to be handed other people's money nearly for free, and hand it back out at a profit, protected by pipes almost no one is allowed to touch and resting on a single unspoken bet. That the money stays, it almost always does, and on the 40 hours it doesn't, no vault in the building will save you.